Today we'll be looking at building a base or a detailed calculation of value. We'll see the differences and the insight that you can develop in both platforms. The agenda that we have, we'll look at both the base and the detail, and we'll look at the normalization process, which is identical and similar. We'll look at how value is created, but we'll understand here and we'll see that in the detailed calculation of value, we can derive a value, in this case, $142,000 higher. We'll understand why we can develop that type of value. We'll understand when to use each report and the bottom line for a particular project. The quick overview of each report is, if we look at the base project or the detailed calculation of value, it develops the most probable selling price, and we're using the weighted average or normalized seller discretionary earnings. And in this case, we're relying 100% on that economic benefit to develop this value of $709,000. In contrast, in the detailed approach, the market approach, comprehensive performance assessment, which we can compare to industry benchmarks. And that's going to give us a lot of insight as to our pricing. And in fact, we'll end up with a pricing of $851,000 here, meaning that we're going to be looking at not only the normalized seller discretionary earnings, just like we did in the base project, but we'll be able to also consider the performance view and a fully supported most probable selling price based on our profitability and efficiency. Sometimes we call those activity ratio analysis. In the base broker opinion of value, we use the market approach. We applied 100% weight to SDE. We had that SDE of 259,000, and we applied the multiple of 2.73, and that gave us a rounded value of $709,000. Now, that value is not based on industry benchmarks or a detailed sense of risk to inform our judgment, okay? That's a key difference there. In the detailed calculation of value, we're using the market approach enhanced by our understanding of performance assessment. So we begin and start with the same market approach, but now we're adding performance assessment. And we can head-to-head comparison to the industry and a filtered comparison group within that industry. We have all of the metrics available to us to form our judgment and understanding about the performance of our subject company. And what we'll find out is that our subject company, in this case, forms its peers in gross profit, operating profit, EBITDA, and seller discretionary earnings. 44% versus 34, 11 versus 7, almost twice EBITDA, 14% versus 8.4, and 20% revenue as seller discretionary earnings compared to the industry. This insight has superior profitability and efficiency, lower perceived buyer risk, and it justifies the higher multiple. This is a fabulous basis why we can sell this business at a premium. In the detailed calculation of value, there's a $142,000 difference because we have a deeper understanding of the quality, the cash flows. The base project gave us a solid floor, $709,000, while the detail gave us a most probable selling price of $851,000. The base project gives us speed. The detail project gives you insight and gives you power. But I want to point out in BizPro Value the impact of the automated calculations, meaning that here we have ordinary business income. Frequently, as brokers, we're taught that we want to remove interest expense and depreciation. And it's important to note that's simply a function of the Excel spreadsheet that we typically are using. In BizPro Value, we minimize the number of entries to avoid errors and automatically capture that. In doing so is that now we have overstated the performance of the company. They don't really make $198,000. EBITDA is not $239,000. It's only $166,000. Seller discretionary earnings is in fact $239,000. Any value that we assign based on EBITDA will also be overstated. So there's two hazards that we risk. One, we've overstated the performance of the company, and we've overstated EBITDA. It masks the operational efficiency. The best practice is, if this is at market rate, make no adjustment here. Let's go back to a project that I've pre-built, And let's take a look and we'll see all of those adjustments. So here in my income statement, I have all of my normalizing adjustments. I reclassified other income. I added another row so that I could be transparent. I made my notes. I made my adjustment to officer comp, to rent, to interest expense, and that employee benefit, and I made my notes there. And I've done that for all 3 years. Now, in the base project, we have 2 active modules, the income statement and most probable selling price. Here I have said that, okay, I'm looking at a little bit of pattern, and I may see that seller discretionary earnings went from 245 in 2023 to 260,000 in 225. So I'm going to put more weight on the most recent year. So I entered 20%, 30%, and then this value is automatically calculated to reflect the balance so that the total is 100%. Then I accepted the default growth rate of 3%. So now I have my year one. And if I wanted to be conservative, I could put 0% here and say, we're going to suggest that growth rate for year one is no more than what they did in the last year. Because inflation happens, I typically like to include a sustainable growth rate of 3%, and that's the default value. So now I see I have my economic benefit or measures, revenue, EBITDA, seller discretionary earnings. I see my multiples, and here I'm going to put weighting on the seller discretionary earnings, and I have a value of $709,000. Now let's look at a detailed project. I want to look at this project, and let's see the difference here. Now, in my income statement, I still have the 3 years, but now I was able to upload all of the other deductions. I was able to find and question my seller about items that had been expensed that I perhaps could adjust out because they were non-operating related and they were discretionary. So in 2025, let's open that year. You can see that I have the same adjustments here, but now this is where I found this miscellaneous operating expense. There may be occasions in the other deductions that there could have been amortization expense. Amortization on the tax return is not included on page 1. It may be identified on page 2, but it is typically recognized or presented in other deductions. So by using TaxRack to gather other deductions, I can see that full list. I have more knowledge and insight, and I may find there are some numbers that are suitable for or maybe subject to normalizing. So here I have the data for all years. I can filter the industry to my subject company's relevant revenue range of 1 to 3 million. Now I see all of the profitability and activity ratio analysis for my subject company compared to the entire industry and compared to the comparison group. I see those in numeric form. I see them in the value drivers module in graphic form. And this, I believe, is a key chart here that says, look at the EBITDA of the subject company, 13.9%. It's above the industry average of 8.4, and it's above our comparison group of 10.7. Now I'm starting to gain some insight into this company that says their operating profit is greater, their ordinary business income is greater, their EBITDA is greater, their profit before taxes relative to total assets is greater also. This is starting to look like a deal that I can sell at a premium compared to what I saw in the base project. I can see my profitability ratios and my activity ratios. I primarily will look at the profitability. This is the money that they make. This is how they make their money or how they manage their cash. And this has a secondary influence, in my opinion, on value. The primary influence or weighting in my judgment is based on the profitability. This company is working smarter than their peers within the same industry. They make more money per dollar of revenue than their comparative groups in that same industry. This starts looking like a deal that I can sell at a premium, and I have a reason and justification why I can show that. so that when I come to my stabilized operations, I can say, all right, let's apply that 3% growth rate where there's more weighting in the most recent year than the least recent year. Here I'm starting to look at a full business plan of year 1 through 5. And when I come back to then most probable selling price, I can look and say, I think this deal should sell at a premium. And the difference is here I have 969,000 versus this 50th percentile, I had 911. $2,000 more than that base project, in part because of the additional normalization that was made. Secondly, if we're selling this business, what is a buyer getting? Now I can start looking at managing the deal, more than just a simple indication of value, which we can find a ton of tools that can do that, but we can't find tools that give us insight. Insight is power. Insight is developed here. I can sell this at a premium, and I can start considering the assets that are included in this sale. Net fixed assets will be included, inventory will be included, but let's look and say, should that inventory be included in the price, or is it additive to the price? So here's where we can come to our working capital annual. We can see what our working capital need would be using the daily cash outflow times our cash conversion cycle, gives our working capital. But right here is where we can understand if the company has excess inventory. And the comparative group from our performance comparison module indicated that the average heating and air conditioning company has no inventory on hand. They order it and they sell it, but they don't have any stock. This company has $22,000 worth of inventory on hand. And because of that, I could suggest that the average company in the ProSite data probably equals the average company in the market multiple data. I can imply that my subject company has $22,000 worth of excess inventory. This $22,000 is additive to the price. So the base project gave us $709,000. The detail project gave us $791,000. That's a $82,000 difference, cash in the seller's pocket. That probably means there's more in my pocket also as a broker based on a commission. So there's meaningful value. The seller sells it at a higher price. The buyer has a clear indication of the inventory that is included, has an indication of why that inventory is in addition to the price, and it's a win-win on both sides of the aisle. We'll come back to our working capital. And remember, undercapitalization is the primary reason why businesses fail. It's not because of the price they paid, the rent expense, the interest rate. It's because they were undercapitalized. They have profit, but they don't have cash. Therefore, the wise and savvy broker is going to include working capital in the deal. Yes, it may be provided by the bank, but in my experience, the bank's allotment is typically understated. Here we have the full daily cash outflow times the cash conversion cycle. We see that this company is likely going to need $46,000. And if we went to the seasonal working capital and found out that the company has some seasonality to it, here we are selling twice as much in the summer as we did in the first month. We could weight this and say if this deal was closing August, our high point might be here, and then we continue through the calendar and pick up January. But in this case, we could see that our seasonal need for working capital is $60,000, not the $46,000. Remember that working capital is that buildup of inventory, the maintenance of that inventory, and the buildup of accounts receivables. And the company is typically not going to have excess earnings after everybody has been paid to fund that working capital need in one single year. Therefore, when we come to our illustrative term sheet, in this case, I'm going to add $60,000 worth of working capital to fund that operating cycle. Now we're selling the business for our $851,000. And we can check our financing model and say, based on that $851,000 purchase price and this injection from the buyer and some seller financing and bank financing at this term and rate, we still have a sufficient debt service coverage ratio. We discussed the base versus detailed projects and how the detailed project gives you more insight. The base project is a terrific tool for that preliminary indication of value, and the detailed project gives you that full approach to develop a highly defendable calculation of value. Thank you so much for joining us today.